Welcome back to Variable Income Mastery. I'm glad you're here for Module 2 because this is where we get into the nuts and bolts of actually managing your variable income. In Module 1, we talked about the mindset shift, understanding that your variable income is an opportunity and not a problem. Now we're going to build the systems that make that opportunity real. By the end of this module, you're going to have 3 specific bank accounts set up. You're going to know exactly how much money needs to go into each one, and you're going to have automated systems that handle most of this for you. No more guessing, no more scrambling, no more sleepless nights wondering if you'll have enough money for the next several months. Let's build your financial foundation. The smoothing account strategy. A smoothing account is the single most important tool for managing variable income. Here's the simple idea. When you have a good month, you put extra money into this account. And when you have a bad month, you take money out of this account. The goal is to smooth out your income so that you have roughly the same amount of money available each month, even though your paychecks might be varying wildly. Let me show you how this works with real numbers. Let's go back to Sarah, our diesel mechanic from Module 1. Remember, her income looked like this over the year. Her total annual income was $36,400. Divided by 12 months, that's $3,033 per month on average. But Sarah never actually earned $3,033 in any given month. She earned as little as $1,800 and as much as $4,100. Here's how the smoothing account fixes this. In January, when Sarah only earned $1,800, she took $1,233 out of her smoothing account. Now she has her full $3,033 to work with. In June, when Sarah earned $4,100, she put $1,067 into her smoothing account and kept the $3,033 for her monthly expenses. The result? Every single month, Sarah has the same amount of money to work with, $3,033, even though her paychecks swing by over $2,000 from her worst month to her best month. That's the power of income smoothing. Calculating your ideal smoothing account size. Now, you're probably wondering, how much money do I need to put into this smoothing account to make it work? Well, here's the formula, and don't worry, I'm going to walk you through it step by step. First, take your annual income and divide by 12. That's your target monthly income, the amount you would have available each month if you had a standard steady paycheck. Second, look at your income pattern from Module 1. Find the month where you earn the least compared to your target monthly amount. That difference is your maximum deficit. Third, multiply that maximum deficit by 3. That's your smoothing account target. Why 3 months? Because you might have more than one bad month in a row. If your slow season lasts 2 or 3 months, you need enough in that account to cover the gap for the entire slow period. Let's do this with Sarah's numbers so that you can see how it works. Sarah's annual income, $36,400. Target monthly income, $3,033. Worst month, $1,800 in January. Maximum deficit, $3,033 minus $1,800 equals $1,233. Smoothing account target, $1,233 times 3 equals $3,700. So Sarah needs about $3,700 in her smoothing account to completely eliminate the stress of variable income. Now, $3,700 might sound like a lot of money if you're living paycheck to paycheck. And here's the truth. You don't have to build this all at once. Sarah didn't start with $3,700. She started with whatever she could save from her first good month, which was about $400. Even with just $400 in her smoothing account, Sarah's worst months became a lot more manageable. Instead of being $1,200 short, she was only $800 short. That's the difference between panic and manageable stress. Where to keep your smoothing account. This money needs to be easily accessible, but you also want it to earn something while it's sitting there. Here are some of your options. First, a high-yield online savings account. These typically pay between 3 and 5% interest, which is way better than 0 you get at most big banks. The money is still completely safe and insured, but you're earning real money on it. Some other good options are Marcus by Goldman Sachs, Ally Bank, or Discover Bank. These are all legitimate banks, not some sketchy online thing. They just don't have physical branches, which is how they can afford to pay you more interest. Another choice, a money market account at a credit union. Credit unions often have competitive rates, and if you're already a member of one somewhere, this might be your easiest option. What you don't want, your regular checking account. The money will disappear into your everyday spending, and you won't earn any interest. You also don't want a CD or anything where your money is locked up. You need to be able to access the money quickly when you have a slow month. Setting up automatic transfers. Here's where most people mess up. They think they'll manually transfer money to their smoothing account when they have a good month. But when you've just gotten that big paycheck, the last thing you want to do is think about saving money for your next slow period. You need to automate this. Most banks will let you set up an automatic transfer based on your account balance. Here's how to set it up. Let's say your target monthly income is $3,000. You want the first $3,000 of every paycheck to go into your main checking account, and then anything above that to go automatically into your smoothing account. So if you get paid $2,500, it all goes to checking because you're below your target. If you get paid $4,500, $3,000 goes to checking and $1,500 goes to your smoothing account. This way, you never have to make the decision. The system makes the decision for you. Some banks make this easier than others. If your bank doesn't offer automatic transfers based on balance, you can still set it up manually after each paycheck. It takes 2 minutes on your phone, but you'll have to be disciplined about doing it. The key is to move that money before you have time to think about it. Paycheck hits your account, money gets moved to a smoothing account, done. Don't give yourself time to think about how you could really use that money for something else right now. The psychology of smoothing. Here's something important about the smoothing account that goes beyond just the math. It changes how you feel about your variable income. Before Sarah set up her smoothing account, every paycheck was either a relief or a disappointment. Big paycheck, relief. Small paycheck, panic. After she set up the smoothing account, every paycheck just became information. Big paycheck, great. Money goes into the smoothing account. Small paycheck, no problem. Money comes out of the smoothing account. The emotional roller coaster stopped because the financial roller coaster stopped. And this is especially important if you have a family. When your income is unpredictable, it's not just your stress, it's your spouse's stress, your kid's stress. Everyone in the house feels the uncertainty. When you have a smoothing account, you can tell your family with confidence, we have $3,000 available this month, just like every other month. The fact that your paycheck was only $2,000 doesn't matter because the smoothing account makes up the difference. The peace of mind is worth way more than the few dollars of interest you'll earn on the money. Smart account architecture. Most people with variable income try to manage everything through one checking account. That's like trying to cook a 5-course meal with one pot. It's technically possible, but unnecessarily complicated. You need 3 separate accounts, each with a specific purpose. Account number 1, your operating account. This is your main checking account where you pay your regular bills and daily expenses. Account number 2 is your smoothing account. This is the high yield savings account we just talked about, where you store money to even out your income. And account number 3, this is your true emergency fund. This is the money you never touch unless there's a real emergency. Medical bills, major car repair, utility bill, job loss. Let me explain why you need all 3 accounts, not just 1 or 2. Your operating account is for your monthly cash flow. Money comes in, money goes out. You need easy access with a debit card, online bill pay, all the normal checking account features. Your smoothing account is for managing income variability. Money goes in during good months, money comes out during slow months. This happens regularly and predictably based on your income patterns. Your emergency fund is for your true emergencies, the things that aren't part of your normal income cycle. If you lose your job entirely, if you get injured or can't work, if your engine dies or you need $3,000 for car repairs, that's the purpose of your emergency fund. Here's why you can't combine these accounts. If you put your smoothing account and your emergency money in the same account, you'll use your emergency money to smooth your income. Then, when a real emergency happens, you'll have nothing. Or if you try to use your operating account as your smoothing account, that extra money will just disappear into daily expenses. You'll never build up the buffer you need. 3 accounts, 3 purposes, keep them all separate. Choosing the right banks. You don't need to have all 3 accounts at the same bank. In fact, maybe you shouldn't. For your operating account, you want convenience. You want ATMs everywhere, good mobile banking, maybe a local branch if you ever need to make a deposit or handle something in person. Your big national banks, Chase, Bank of America, Wells Fargo, might not be your best friends, but they're convenient. For your smoothing account, you want the highest interest rate you can find. This is probably going to be an online bank. Marcus by Goldman Sachs, Ally, Capital One 360, Discover Bank. These consistently offer rates that are 10 to 20 times higher than big banks. For your emergency fund, you want high interest rates and rock-solid stability. Again, this is probably an online bank, but it might be different from your smoothing account. Shop around for the best rate. Here's a trick. Some online banks have promotional rates for new customers. You might get 4.5% for the first year, and then it drops to 3.8%. There's nothing wrong with moving your money around to chase these rates as long as you're dealing with legitimate FDIC-insured banks. Avoiding fees that eat into your variable income. When your income is variable, bank fees hurt more than they do for people with steady paychecks. A $35 overdraft fee when you're already having a slow month is brutal. Here's how to avoid the most common fees. Overdraft fees. Set up overdraft protection that transfers money from your smoothing account to your checking account if you accidentally overspend. Most banks offer this for free or for a small transfer fee that's way less than an overdraft fee. Monthly maintenance fees. Many banks waive monthly fees if you maintain a minimum balance or set up direct deposit. Read the fine print and make sure you qualify for the waiver. ATM fees. Use your bank's ATMs or find a bank that reimburses ATM fees. Some online banks will refund all ATM fees, which is amazing if you travel for work. Transfer fees. Some banks charge you to move money between your own accounts. That's ridiculous. Find a bank that doesn't do this. Low balance fees. Some banks charge you if your account balance gets too low. This is especially problematic when you have variable income. Avoid these banks. The goal here is to pay $0 in banking fees. With a little shopping around, this is completely achievable. Mobile banking for real-time management. When your income changes from month to month, you need to be able to check your balances, move money around, and manage your accounts from anywhere. You can't wait until you get home to a computer. So, make sure whichever banks you choose have excellent mobile apps. You should be able to check balances in all your accounts, transfer money between accounts, deposit checks by taking a photo, set up automatic transfers, and get alerts when balances get too high or too low. The best mobile banking apps also let you categorize your spending, set savings goals, and get insights into your financial patterns. This stuff isn't essential, but it's helpful when you're managing variable income. One feature that's really useful, balance alerts. You can set up your bank to text you when your checking account gets below a certain amount or when your smoothing account balance gets above a certain amount. This helps you stay on top of your money without having to check your accounts obsessively. The $1,000 rule and surplus strategy. Earlier, I mentioned setting up automatic transfers so that the first $3,000 of your paycheck goes to checking and anything above that goes to your smoothing account. This was just an example using Sarah's numbers. But there's an even simpler version of this that works for almost anyone, regardless of your income level. I call it the $1,000 rule. Here's how it works. The first $1,000 of every paycheck goes into your checking account for immediate expenses. Everything above $1,000 goes into your smoothing account. Why $1,000? Because for most people with variable income, $1,000 covers the absolute essential expenses for 2 weeks. Rent, mortgage, utilities, groceries, gas. It's not enough to live on comfortably, but it's enough to survive until your smoothing account kicks in. So if you get paid $800 one week, it all stays in checking because you're below that threshold. If you get paid $2,800, $1,000 stays in checking and $1,800 goes to your smoothing account. This system has a huge psychological advantage. You never feel broke after getting paid, even in your worst weeks. You know you've at least got $1,000 to work with immediately. Scaling the rule based on your income floor. The $1,000 rule works for a lot of people, but you might need to adjust it based on your specific situation. If your absolute worst paycheck is ever less than $1,000, you need to lower the threshold. Maybe it's $800 or $600. The rule is that your threshold should be less than your worst paycheck, so that some money always goes towards your smoothing account, even in slow periods. If your worst paycheck is never less than $1,500, you might want to raise the threshold to $1,200 or $1,300. This gives you more immediate cash flow into your checking account. The key is to set it once and leave it alone. Don't just adjust it every month based on how you're feeling or what expenses are coming up. The whole point is to remove the decision-making from the process. Psychology of paying yourself first. There's an old personal finance saying, pay yourself first. The idea is that you should save money before you pay your bills, not after. For people with steady income, this advice is pretty straightforward. Your paycheck hits your account, you immediately move some money to savings, then you pay your bills with what's left. For people with variable income, paying yourself first is even more important, but it works a little differently. When you get a big paycheck, let's say $3,000, your brain immediately starts thinking about all the things that you could do with that money. Maybe you've been putting off some car maintenance. Maybe you want to take your family out to a nice dinner. Maybe you just want to feel financially secure for a few weeks. All of those feelings are normal and understandable, but if you spend that $3,000 on current needs and wants, you'll have nothing left for next month when your paycheck might be $1,500. The automated transfer system solves this problem. The money gets moved to your smoothing account before you have time to think about it. You're paying your future self first before you pay your current self. This isn't about depriving yourself, it's about making sure your future self has the same opportunities as your current self. Adjusting percentages as your buffer grows. When you're just starting out with the smoothing account system, you might need to keep a higher percentage of every paycheck for immediate expenses. That's fine. You're building the system gradually. But as your smoothing account grows, you can afford to put a higher percentage of your big paychecks into savings. Here's how this might evolve. Month 1, you keep the first $1,500 of every paycheck and save everything above that. Month 6, your smoothing account has grown, so now you keep the first $1,200 and save everything above that. Month 12, your smoothing account is fully funded, so now you keep the first $1,000 and save everything above that. The exact numbers don't really matter. What matters is that you're gradually shifting towards saving a higher percentage of your surplus income as your financial foundation gets stronger. Eventually, you might want to get to the point where you're saving half or more of your big paychecks. That's not deprivation, that's just financial security. What happens when your smoothing account gets too big? Hey, this is a good problem to have, but it's still a problem you need to solve. What happens when your smoothing account has way more money than you need for income smoothing? Let's say you've calculated that you need $4,000 in your smoothing account to handle your income swings, but over time, you've built it up to $8,000. That extra $4,000 should be moved somewhere else, either to your true emergency fund or to longer-term savings and investments. The smoothing account has one job: to smooth your income. Don't let it become a catch-all savings account because you'll be tempted to rate it for non-income related expenses. Keep your smoothing account at the right size for its purpose and find other homes for your additional savings. Wrap up. All right, let's recap what we've built in this module. You now understand the smoothing account, the single most powerful tool for managing variable income. You know how to calculate the right size for your smoothing account, where to keep the money, and how to automate the transfer so you don't have to think about it. You've learned about the 3-account system: operating account for daily expenses, smoothing account for income variability, and emergency fund for true emergencies. Each account has a specific purpose, and keeping them separate is crucial. You've learned about smart banking choices, finding banks that work for your situation, avoiding fees that eat into your variable income, and using mobile banking to stay on top of your money. And you've learned about surplus capture, systems like the $1,000 rule that automatically save your excess income during the good months without requiring any willpower or decision making. And here's what I want you to do before the next module. Set up your 3 accounts. You don't need to fund them fully right away, but get the accounts open and the automatic transfer set up. The systems we've talked about only work if you actually implement them. In Module 3, we're going to talk about budgeting, but not the kind of budgeting advice you've heard before. We're going to build a budget that actually works with variable income, starting with your worst months and building it up from there. The foundation that you've built in this module, the smoothing account, 3-account system, and automated transfers, that's what makes everything else possible. So, I'll see you in Module 3.